Hi there. Thank you so much for joining us this afternoon, and thank you for your patience as we get started today. For those of you who don't know me already, my name is April Reed Cruz, and I am co-CEO of Reed Financial Group. If you know me at all, you know that technology is not my friend, and anytime I'm involved in it, we have some sort of a challenge. So thank you again for your patience as we get started today. We have a very special guest with us today, and we're very excited to bring this topic to you. And the times that we're in right now, certainly unprecedented in many ways. And we get that comment almost on a daily basis from the people who we work with. And we're so fortunate as fiduciary advisors who are independent to be able to really choose who our partners are going to be. And our guest today, along with my co-host and sister, co-CEO Abby Reed, and Mark DiOrio. He is the Chief Investment Officer of Brookstone Capital Management, a very important partner of Reed Financial Group. He helps build the portfolios that we utilize for our clients and really bring the institutional style of investing to the individual investor so that the individual has a chance to perform like the large institutions do. And that's something that we feel is very unique. Mark is very well versed on portfolio construction. He's got 20 years of experience in doing what he does for us. And Brookstone Capital Management, again, a fantastic partner for us as our registered investment advisor firm. And they are also fiduciaries. So he's going to talk to you today about some of the things that we're doing in today's times to help our portfolios perform in periods of time where we're seeing volatility across the board with stocks and bonds. So Mark, without further ado, we thank you so much for being with us today. And we look forward to having you share with us, and know you have some poll questions that you'll be sharing with us as well.
I do, and thanks for that intro, April. Happy to be here. Hi, Abby. Great to be here. There's a lot in the news for sure. And I wasn't going to belabor the news because the news does it better than I do, but there's a number of reasons to be bearish or kind of have a dour outlook, if you will. Ours is much more balanced. We know in the short run, there's some market challenges here, but what I was going to talk about today is actually some longer run challenges as well, and how we're starting to construct portfolios for not just today's challenges, but also the challenges we see unfolding over the next several years. And so I thought I'd start with a poll question, and you can use this, I'm not actually taking it. You can answer quietly, and I'll give the answer. But April and Abby, you guys get to pick, if you will. So one of the things you do, as April was mentioning, from an institutional money management side. So if you were a consultant to a large pension fund, how do they go about approaching their asset allocation or their investment program? Well, it all starts with what are called capital market assumptions. And that can be really translated in English to, what do you expect the market return to be over the next 10 years? And so in this question, that's all we ask. What do you expect the equity market to return over the next 10 years, annualized, so per year? A, greater than 20%, B, between 11 and 20%, C, between 1 and 10%, D, down between 1 and the negative 10%, or down more than 11% annualized. And hopefully nobody picks E, and that would be a very challenging environment, obviously. But April, Abby, I'll let you guys give a choice.
So I don't want to cheat because I actually saw you do this already, Mark. So I'm going to let April, since I don't think you've seen this.
You're going to let me take the Ouija board out, huh?
Yep.
I'm going to go with option C.
C. That is an excellent pick, and I would expect nothing less. So the reason we pick C, 1 to 10%, and why that's a very solid fundamental answer, is because if you look over time, and I know this chart might be hard to see, but that blue line there that goes from the lower left up to the right, kind of at a 45-degree angle, that stocks over time. So the stock market actually has a long-run annualized return of about 10.3% annually over a long period of time. Of course, every day the markets are going up and down, every quarter, every year they go up and down, but over time that's been the average return. So you start at that 10% number. And the reason where you'd say, would we have a return figure that might be above that 10% annualized, even to get into those double digits and maybe even above 20% annually, that only happens when the market is significantly undervalued. And that happens, this is a chart of valuation. It's called the Shiller PE, or price to earnings ratio. And really what this is showing is there's certain periods of time when the market is undervalued at these lower levels and overvalued where you see those red arrows. And this isn't necessarily to be interpreted as a negative sign when I show those red arrows there. It's just showing historically where the market is at on the upper right. Currently, it's at a higher valuation, and this is a longer term valuation measure. And what it really tells us is we can't expect those really high annualized returns. When could we? Well, if you look closely at the chart, right around 2009, 2010, right after the global financial crisis, when stocks had already declined significantly. So we've gone through a little bit of and a pretty sharp correction year to date, which has put valuations back into decent alignment, but not into alignment that would say, okay, now that stocks have really come down tremendously, you can expect huge double-digit annualized returns. That's not the case we find ourselves in. So that 1 to 10% is consistent with market history, and it's consistent with these valuations. So April, excellent selection. I would agree with you. So that's a reasonable starting point from your assumption in terms of what returns. Now, the harder question for people might be, is it's not just stocks. Stocks get all the headlines, all the news, all the hemming and hawing, all the volatility. But really what's going to be important from this moment going forward is, what do you do about bonds? What are traditionally the safe or conservative side of the portfolio, and really are a key building block for portfolio construction, especially as you're nearing or in retirement. The traditional advice that I'll mention in a few slides is that advisors generally talk about you should move out of stocks and into bonds. I'm not so sure that's a great advice in this market in particular. So what do you expect bonds to return per year over the next 10 years? And so this is poll question 2. A, greater than 6% annually. B, between 3 and 6%. C, between 0 and 3%. D, down between 0 and negative 3%, or down more than 3% annually per year. Abby, I'll let you pick, even though you've heard, but you can also pass this to April.
If I get it wrong, that's really sad, because I've already seen this before. See, I say from 0 to 3%.
April?
That was going to be my guess as well, somewhere between there and possibly D, somewhere in that range is what I was considering there.
Excellent choices. And so today's your return on bonds going forward, looking out 10 years, is consistent with your starting yield. So whatever the yield you start at investing. So right now, yields are about 2%. In the 10-year treasury today, they're about 2.3%. And so the return on that bond is going to be, over 10 years, 2.3% annually. And so this throws people off because they look historically and do a back test, and bonds have returned in that 5 to 6% range. However, because yields have come down so low, so quickly, especially after the COVID and the pandemic economic environment, yields have come down so low, you have to contemplate this situation, because your returns, because they're locked by your starting yield, there's no secret in terms of the return stream. So you're in that 0 to 3%. Now this is a challenge that's very unique, especially in the retirement era, where you're used to getting decent returns out of bonds. But what happens if their yields are as low as they're going to go, and either yields start to move higher, which means the value of the bonds decrease, or they just stay at these low levels? Now we think they're going to generally stay at these low levels, but nevertheless, it's really something you should consider. What do you do about the bond side of your portfolio? And we spend a lot of time on this. And again, it doesn't get the headlines that stocks do. They don't get TV channels dedicated to them reporting how bonds are doing. They might put up there what the interest rate is, but they really don't talk about the bond market, which again is just as large as the stock market and just as important, especially in the pre-retiree category. And this is at a moment with these low yields that their yields are below the rate of inflation. So everyone's seen on the news, of course, and feeling it if you go to the grocery store or anywhere else, that inflation has really shot up. And right now at the gas pump, of course, that inflation is running at that 6 to 7%, almost at an 8% level. That's pretty remarkable. We've been in these 2% ranges for a long time. And now what you see on this chart is that dark green line there is interest rates from bonds. The light green is CPI, or the inflation rate. Generally, yields are above the rate of inflation. And so this really jump that we just saw over the last year or so is unique. Usually bond investors were getting enough return that they were outpacing inflation. Today, that's not the case. The yield is not enough to compensate you for the inflation, which tells us that what that means is you're getting a negative real return. So there's something called a real return. That's after you factor in inflation. So this is a big, big turning point. And in fact, we think inflation is going to stay above the bond yield for an extended period of time. And so this really has to factor into your portfolio. So when you build a portfolio, and then really the main reason why you're building an investment plan is to maintain your purchasing power over time and grow that purchasing power over time. Well, it's really hard to do that in the bond market when you're not keeping up with inflation. And really maintaining your purchasing power and growing that purchasing power is about outpacing or maintaining at least a return at or above the inflation rate. And so bonds aren't really going to do it. And so this is really a big challenge. And what this chart shows is we haven't seen this challenge for investors in 40 years. And we think it's going to continue to play out. The general advice in the industry, it's called the industry glide path. And what this chart reflects is the percent that advisors or the industry suggests as a guideline that investors maintain in equities or stocks. So in your early working years from 25 to 40, your maximum equity stock exposure, and then you start to decrease that stock exposure all the way down when you get to 65, 70 in that retirement era, and even at the 55 mark, kind of the pre-retirement era, you're really starting to dip below 50% in stocks per the recommendation. And what it's telling you is a recommendation simply based on your age to move out of stocks and into bonds. It does not take into any account the outlook for the asset class. In other words, it's telling you just sell out of stocks and move into bonds. They're doing that because the advice is let's reduce volatility or stocks. But now all you've done when you use this glide path is move into bonds and assume the other risk, which is the inflation risk, which is a bigger risk than short-term volatility. What you'll find is volatility kind of ebbs and flows, but over time returns smooth out. On the other hand, inflation is persistent. And if you have very high inflation, it's really challenging, and especially above the interest rate. So the bonds that you're moving into are not going to maintain their purchasing power. And by the way, if you have a target retirement date fund, maybe in your 401k or retirement plan, we think they're great in those plans. But if you're nearing retirement, you have to consider that all those funds are using this idea, which is we're just selling stocks and buying bonds per the mandate of the fund. So while they're good while you're in the 401k plan, as you're starting to plan in today's environment, you have to contemplate that they're just moving into bonds and selling stocks, and that may not be what you want to do. And so we've really tried to point this out to investors that this is an area you want to think about. You just don't want to necessarily move into bonds at this environment. You want to really have a thoughtful design to your portfolio of how you're going to generate income and how you're going to maintain a traditional moderate portfolio return. The other issue with bonds is that the stock bond correlation, not to get too wonky in the terms, all this is telling you is that stocks and bonds are moving together. And this is a new phenomenon. It broke out to a new high, which told us in this first quarter of this year, 2022, we've seen stocks and bonds move in the same direction. In other words, historically, when stocks sold off, you'd see bonds actually hold up very well and kind of stabilize the portfolio and mitigate volatility. This year, that hasn't happened. Bonds move down as much as stocks, if you can believe that. So a lot of conservative investors that may have been too conservative and gone too much into bonds, will see losses similar in magnitude to stocks, but they also don't have the upside participation. So they're not providing the same diversification benefits that they had been historically. So this is a real risk for investors that I think is out there and is going to continue, along with that inflation risk. In fact, when you take it even a step further and say, what else is the challenge? Well, the challenge is the yield, or the organic income coming off the portfolio, is essentially at 40-year lows as well. Meaning if you take a traditional 50% stock, 50% bond portfolio, which is a traditional moderate, usually you'd get a return, or historically, you'd be in that range of getting a 3%-ish, and even 4% or in earlier times kind of yield, but that's interest and dividends coming off of your portfolio. Today, you're at close to 1.5%. So if you use a rule of thumb of withdrawing, which is general in the industry, of 4% of your portfolio annually, then adjusted for inflation, you're coming right out of principal because the yield or the income is not picking that up. And so that's a real challenge as well. And I think is a surprise to a lot of investors. And the inflation factor is very slow. You don't realize how much of a toll it takes until you think back, until you go 5 years and then 10 years. And then even longer, since especially retirement duration is a lot longer than it used to be. So if you go back even 20 years, you'd say the prices of houses, the prices of cars, prices of medical care, they've all doubled. Well, with interest rates at 2%, you're not going to get there or keep up, where stocks have done that. So you want to figure out what's the right mix, and then how do we blend that while maintaining that consistent risk profile. So this is called the capital market line. All I wanted to point here was, and I know it's a lot of data if you've never seen this before, which is the expected return on a traditional portfolio that combines stocks and bonds, similar to that 50-50 or 60-40, it's called in the industry, 60% stock, 40% bond. That's a moderate risk profile. The risk profile, or the return profile, has actually dropped. And the reason it's dropped lower than it's been historically is because interest rates are lower now. And we just talked about the poll question. There was a reason we did the poll question, because you have to have that, I think, foundation to say, wait a minute, you're only going to be in that 0 to 3% band for fixed income. You're not in that 5 to 6% range for that income. So naturally, you pull returns down. And it's not necessarily stocks that are going to pull that return down. It's really that bond component. Stocks will continue to be volatile, but they'll continue to earn a return in excess of inflation over time. One of the ways we have been building portfolios to address this issue of, okay, well, what do you do with this bond side of the portfolio, is we've been building what's called multi-asset, multi-strategy portfolios, where you start to include additional things that are not part of the traditional mix, but do make sense in this environment, such as something called hedged equity. You can add some commodity exposure, some other real asset exposure, and a few other things. So you can add all that into the mix. And I know, April and Abby, we talk a lot, and I know how much you care about the clients and their outcomes. And these are the questions we keep asking ourselves. What do we add to portfolios to really offset this risk, but maintain the same risk profile? So how do you augment the return, augment the income? And so we have a couple of good ideas in terms of how we do that. So when we look at a portfolio, and our overall portfolio construction process is built on what's called a core plus satellite design framework. So what that means is we build a core model that combines stocks and bonds, and then within that we make certain allocation adjustments to large cap and small cap stocks, and to short duration or intermediate term bonds, and sometimes corporate bonds, sometimes U.S. Treasury bonds, just to offset the risk in the equity portfolio. That's your core risk-appropriate portfolio. So we determine the mix between stocks and bonds based on your risk profile. Of course, if you're more aggressive, you get more stock exposure. More conservative, you get more bond exposure. But what we want to do is augment that. How do you augment the traditional core portfolio? Well, you add either one or a few different satellite ideas that can be blended into the portfolio, and they can focus on income generation. They can focus on maybe some defensive or additional growth opportunities. And so one that might be very new to people, because it's relatively a new concept. We've seen these and we've been researching these for over 3 years now, and we've now been really started to blend them into portfolios, and they've been really well received by both advisors and investors alike because they play a real serious role and address concerns that investors have today, which is how do I maintain, again, my risk profile, but maintain that traditional return that I've grown to be accustomed to and keep up with inflation. Well, something called defined outcome or buffered ETFs. ETF stands for exchange traded fund. And what they are is really today's version of the mutual fund. So the mutual fund came to fruition really in the 80s and 90s. That was really the product that most investors allocated to. Then ETFs have kind of taken over. They combine the diversification benefits of a mutual fund, but they trade all day like a stock. So you can really they're very liquid. You can trade them if necessary, but you do get that nice diversification as well. So here's a concept where a firm called Innovator, there's other firms that do this as well, but this was just the example that I took, and we monitor the entire investment landscape. What they do is they allow you to invest in a certain asset. So SPY up there at the top is the S&P 500 index. What they've done with these ETFs is put in buffers, meaning they protect a certain percent of the downside of the market. So you would not experience that percent of the downside over the outcome period. So for example, the downside buffer could be either 9%, 15%, 15%, or it says 30% there. That's between a -5 and -35%. So what that means is anytime the market drops, let's say if it was to drop 10%, and I'll show a slide of this, the buffers would kick in and it would mitigate your losses. So if it was the 9% buffer, you'd only be down 1% over the outcome period. If it was the 15% buffer, you would be flat over that time period because the ETF absorbs the first 15% of the downside. Now you get a performance cap on the upside, so a maximum return over what the outcome period is, a 1-year time frame. Now these are fully liquid, they trade daily, but this is the concept. And I know you probably want, there might be more questions of this, but I'm really just introducing these as really innovative tools where you can kind of select and reduce your risk with a really easy, fully liquid, transparent investment vehicle. And so here's an idea all the way to the left. This is using the 15% downside protection over a 1-year period. And the cap, or the maximum return, is 10%. And where do you get that from? It's just linked to the S&P 500. So if the S&P 500 is up 10%, then that ETF's up 10%. And in this case, this just gives you an idea. So if the S&P is down 30%, you would be down 15% because it absorbed that first 15% of the downside. So you didn't participate in the losses. A normal correction, if it was just down 10%, you wouldn't be down anything. If it was up 7%, you'd be up 7%, so the cap doesn't come into play. And then a high growth market where you'd be up 30%, this cap was 12%, you would cap out at 12%. So it's very attractive from your expected risk and return. It mitigates volatility very well. Sometimes people ask what it looks like. This is a good idea, and if you haven't seen this, this is okay. April or Abby can go through this in more detail, of course, if anyone has questions. But the idea is very simple. That this is showing you an ETF that tracked the market, that used during the recession or the bear market that developed in March of 2020. And so this is going from a 1-year period, basically April 1st of 2019 to April 1st of 2020. And the dark green line there is the ETF or your investment versus the S&P 500 index. And so it shows you the cap. This one had a cap of 10.6%, but it has a buffer of 15%. So as you move from left to right, you can see it basically tracks the S&P 500. Then it goes towards that cap and it doesn't go any higher. And then the market drops very suddenly. It was the fastest bear market in history. And then it has a little bit of a bounce. But what you notice with the ETF is the ETF was within the buffer range. And so at the end of that period, it was actually flat, 0%, where the market was down 10% during that time period. So it worked even in a very extreme environment. So this gave us the confidence that these investment vehicles have been stress tested and have been working as expected. And that's really important when we do any type of investment research or put them into a portfolio. The other concept I just want to mention was, you notice I mentioned caps, which means the maximum return you could earn over the 1-year period. However, as you get close to a cap, because they are ETFs, exchange traded funds, and they trade daily, if they get to that cap level, so we're in a great, let's say we're in a really strong market, you can actually trade out of that ETF to the next one. These are issued on a monthly basis, and so you can just up the cap, and that's what this is pointing to. It's a strategy we use. You don't necessarily have to do anything. We're managing this, so if an ETF gets to the cap after 3 months, we don't just sit there and wait for 9 months. We re-up to the next cap, which gives you another 10% on the upside in round figures and another 15% downside buffer. So we do that over time, and so are really managing this. And we're really excited about this, especially when we think you're not really giving up gains if you have a 10% cap in there, as an example, when the expected return is in that 1 to 10% range for stocks anyway. If it was one of those very cheap moments in the market where we were deep bear market and stocks were unseasonably cheap, we'd say, well, maybe you have the 20% annualized returns or somewhere in that range expected, but we're not in that range, and we're not expecting to be in that range for quite some time. Another idea I just wanted to mention was that was kind of a defensive play to participate in the markets, but what about how do we generate income? And so something we've really pioneered and worked with different capital markets desks globally is something called a structured note. If you haven't heard of structured notes, they are very common. That industry is about $3 trillion in size right now. What they are financial products issued by large banks. So it's not the bank that issues these. It's actually what's called the capital markets desks, generally in New York, of these banks. And they go out to financial professionals and give different terms. So one of the benefits of structured notes is you get predetermined terms and returns and risk profiles. And it's linked to a traditional underlying asset. And I'll give you an example of that too. These are issued monthly, so you won't miss one. If you liked one that was last month, well, there's a new one this month, and then there'll be a new one next month, and so forth. These are really, what we're doing is trying to combine financial instruments and deliver these terms to investors. And so we work with all these different banks. So all the usual suspects, pretty much the largest banking groups all have capital markets desks. And then we shop for the best terms amongst those. And in fact, we've become a large enough player in this industry where we actually customize a note that's only available through Brookstone specifically, and Abby and April have access to those and allocate to those. And so there's different types of structured notes. There's a lot of these out there. What we try to do is distill this into something. There's principal protected notes, there's income notes, there's growth notes. And just to demystify structured notes for a minute, if you haven't heard of them, they're just a different investment vehicle. They serve a different purpose. So everyone's heard generally of mutual funds. You participate in the markets. There's usually a stock or a bond basket in there, a number of different stocks, number of different bonds, and you invest there and you participate in the movement of that basket. Hedge funds usually come out and say they have a return proposition or kind of an edge in the market. They have a trading strategy and so forth. And then structured notes, they have a payment proposition. They just tell you what the terms are. Here's kind of the upside. Here's kind of the income or the coupon. Here's some of the downside protections. So they're just different vehicles that serve a little bit different purpose. And here's what's called an income note example that we've been using, and we've been doing this every month for about 6 years now, issuing these. And so there's just a few things to know about these. I'm just touching the highlights here. And we're allocating these into portfolios, into traditional portfolios, right on traditional custodians. So TD, Schwab, just kind of the traditional main custodians all hold these assets. So it's very straightforward. But what you want to know is who the issuer is. So you have an issuing bank. In this example, it's Citigroup. And again, this isn't where you'd go into your bank. This is the capital markets desk. So they go out to financial professionals. The pricing date on this one was May of 2021. The term is 12 months. So this is a 1-year note. It has an identifier there, and then you look for, well, what's the coupon or the interest that it would pay? The minimum coupon on this note was 9.1%. So if you can think about where interest rates have been, 9.1 obviously sounds very compelling and a very unique source of income that you can bolt onto your portfolio in that satellite allocation. Now that coupon type is fixed, and that income comes in on a monthly basis, so you immediately see cash flow. Now it's a little bit different from a bond in the sense that your principal, it has a little bit different terms. Your principal is actually linked to the S&P 500, the Russell 2000, the NASDAQ 100. So 3 traditional indexes, and your principal is guaranteed repayment at par at maturity as long as any one of those 3 indexes do not drop below 30% from the initial date. So that's why we start to suggest, say, well, sometimes the market could drop 30%, but you don't put all your money in one note. You actually ladder your investments. And so it mitigates any of that one note risk. But 30% is a pretty big drawdown. And so we found that to be kind of the sweet spot in terms of finding approachable or attractive yield and also mitigating any chance for principal kind of protection. So that can be, there's 2 types, it's called American and European. One says it's only, the market has to be down 30% after 1 year. And if it's not down 30% after 1 year, then you get full repayment of principal back, as well as you've earned all those coupons as well. So this has been a really unique source. So you get this income, but it's not linked to interest rate risk and some of the other issues of traditional bond risk. And we use, as you mentioned, Citigroup. I mentioned Citigroup, but we're all looking at the credit quality of these issuing banks. So it's a really, really unique structure as well. So when you combine a couple of these different ideas, you really start to embed these satellites as part of a portfolio that offsets certain risks. So you put the portfolio, let's say it's a traditional 60% stock, 40% bond portfolio, but you add 20% in satellite allocation. So that could be either all in the income generation sleeve or all in the defensive sleeve. What that does is you take it from both stocks and bonds. A lot of times when we see portfolio construction, they just take allocations from stocks and leave the bonds alone. But we think in this environment, it makes sense to find investments where you could take some out of that bond component and reduce that risk you have in bonds, or at least augment that bond portfolio with additional income sources and make up and almost get to that traditional yield that bonds would be yielding, and in certain investments, definitely higher. But doing this, you don't change your risk profile. It stays the same risk profile in this case. You get maybe a little bit different return potential, a little more income generation, and also very specific downside protection. So those are really a lot of key components, we think, for building portfolios for today's challenges. So they're really important, and we're really excited about. So that's really all the slides I had prepared, and I hope, I know we went pretty quick through these, but April and Abby, I'd be happy to kind of wrap it up with you guys, or any questions you had.
Definitely. That was awesome, Mark. Thank you so much for going into detail and also keeping it very, very simple at the same time. So I always appreciate about that, how you teach. It's easy to understand, but it's also very detailed. So something that I think that we've run across quite a bit with people that are, seeking help from an advisor is they hear about a lot of the things that we've talked about, and they're wondering, why do I even have bonds in my portfolio? Or we've seen some people make the maybe mistake of over allocating to stocks, depending on where they are. We work with, mostly people that are nearing retirement or even in retirement. And so I think it's important to remember why these other things need to be a part of a good, solid portfolio. So you have to think about sequence of returns risk, and also risk profile and risk tolerance, because one of the most important things, and I know that you talk about this a lot, Mark, is being able to have an investment strategy that you can stick with. So if you could just speak to the importance of having a well-balanced and well-rounded approach like this chart shows here.
Definitely. And I think it's important. I've been doing this. You mentioned 20. It's actually been over 20 years now. But anyway, about 70% of the people that have come in kind of in the wealth management door since I've been in the industry, they'll have a mismatch between their investments and the risk profile or tolerance that they have.
Mm-hmm.
And so for us as professionals, as you know, we look at their risk profile, and then we look at their investments, and we want those to line up. And a lot of times it changes. It can change for circumstances or a variety of reasons. But we're trying to build, I like the word appropriate. What is the appropriate portfolio given market conditions today, our investment opportunity set, a lot of what we talked about here today. And then third, what your expectation is. So a lot of times investors might have a different expectation and not realize that bonds make up a big component of that portfolio. And if your risk profile is very conservative, the advice is to go more in bonds. We're trying to offset that, of course, but investors wouldn't necessarily know it because bonds sometimes get lumped in with investments and broadly thought of as stocks. And so it is important to find that right mix, that right portfolio that you can stick with. And that's why you go with the risk profile to help us guide what's the best balance between stocks, bonds, and satellites to make sure we get you to the best return, taking the least amount of risk. And that really is not identifying the best investment. You won't know that until hindsight anyway, but we do know how to build an appropriate portfolio for your condition. And that's what you want to do, kind of balance out the risk and reward components so you can ride through multiple market cycles as fast changing conditions hit. Because the worst thing that you can do is, get emotional if you're over allocated in one area, and then all of a sudden, if the market goes against you, you get very emotional and sell out and not really have a plan to re-enter, and that becomes even more and more challenging.
Right. Yeah, thank you for touching on that. April, do you have any questions before we wrap this up and let
One
Mark
more
go
that
back?
I'd like, absolutely, thank you both. And Mark, again, like Abby said, just to reiterate, I mean, hit it out of the park as always, and taking something very complex and finding a way to simplify it a bit and make it a little bit easier to digest. And could you just cover for us before we wrap up today, the distinction between a buy and hold, say 60-40 portfolio, and having an allocation that's tailor-made to what the specific needs are and sticking to that portfolio design? Could you just kind of speak to the differentiation a little bit between buy and hold and sticking to the investment methodology?
Sure. So buy and hold is really based on historical assumptions about the market. And today, and if nothing else, the one key takeaway should be, well, if you relied on that buy and hold in the bond market, your buy and hold return is 2%. It is not going anywhere because yields are so low. And so that's your return over the next 10 years. And this is where we're saying, look, we have to be very thoughtful about portfolio construction today and really start to add some enhanced opportunities that you can augment those risks that have built up in those traditional core buy and hold assets, where you'd say, well, if you were in bonds, you would have done fine. However, we just saw there's a slide earlier where for the last 40 years, yes, your interest was higher than inflation. Now that's not the case. And for a few years, it was about on par, but now that's not the case at all. And inflation will probably outpace interest over time. So if you're just buying and holding, you could, but that doesn't make a lot of sense on the bond side of the portfolio at all. So we've spent a lot of time on that side of the portfolio, making portfolio adjustments. There's a few things you can do. I didn't touch on those, but the way you structure the bond holdings and make certain changes when yields change, but also adding these satellite components. And I mentioned we ladder these satellite components. So you really have some activity in there in the portfolio, and different on a monthly basis, you'll have different yields coming in. And so that'll just, once you get the ladder rolling, you just continue to do that and identify opportunities that pop up in the marketplace. Because one of the areas we look at first when there's a lot of volatility in the market is, hey, did we get a bigger coupon because of the market environment, and that may necessitate maybe a little bit larger allocation from an opportunistic perspective. And I think if you think over the last 5 years, you don't even have to go that far back, but how sharp the movements in the market have been. This year has been very sharp. You go back to 2020, that first quarter was very sharp, down 30% in 30 days, a very sharp move, and then a very sharp move back up. Then the fourth quarter of 2018, and then 2015, 2016 had almost a bear market. It was pretty wobbly there for those that don't remember. I do. There was basically 16% or so corrections in the market, kind of in the fall of 2015, and then again in early 2016. So every couple of years you have this kind of panic attacks in the market that are just moving so sharp, but they also bring about some opportunities to just do some slight adjustments to the portfolio in those moments where you can really capture a lot of value versus the buy and hold. You're subject to all those whims. And then on the bond side, you're not taking advantage of some of the opportunities, and you've kind of landlocked yourself to those low returns.
Thank you very much for that.
Thank you, Mark. So I know there's a lot of reasons, I was thinking about this right before we started, for investors to feel pretty pessimistic. And I mean, people in general, because of everything that's been going on for the last couple of years. It seems like it's crisis after crisis. And I know I'm bombarded with headlines, and they're always, it seems like the sky is falling, and that's what they do, as we've talked about. It seems like every week something else is going on. But what I really like that we highlighted here and try and talk to our clients a lot about is, and something that you just touched on, is that even though there are what seem like really unique challenges today, we know that every year, we don't know what they're going to be each year, but we know there's going to be challenges every year. And our portfolios, with your help and with the investment committee's help, are built to be able to weather those storms, no matter what they are, and the adjustments that we're able to make proactively, and then the opportunities that are created when these things happen, we're able to take advantage of those and help our clients figure out the right allocation. And with Brookstone's help, you guys really help us to, there's so many options out there, and you are able to do the due diligence, with us, and we're able to match it to the clients and really figure out, what's best for them, what's most appropriate for them, and what's going to have the best long-term solution for them. So we really appreciate the partnership with Brookstone. I think most of our clients now, after watching this, understand, why out of all the firms that we could have chosen to partner with, we chose Brookstone. And you're always a huge help and always so available to us. And we really appreciate that. If anybody wants to continue this conversation with your advisor, you can give April and Daniel a call at 678-252-2110. If you'd like to talk to me, my number is 678-442-0255. April, Mark, anything else you wanted to add before we sign off?
I think you've done it, Ab. Thank you so much. And we appreciate all of you being with us. Mark, certainly appreciate your time as always.
Yes, thank you.
Definitely. It's been a pleasure.
Awesome. Thank you, Mark. We didn't get a joke, though. We usually get a joke.
Well, ever since quarantine, all my jokes are inside jokes.
Awesome. We got one in. That's a good one. I'm going to steal that.
Thank you so much.
Thank you, Mark. Thanks, everybody,
Thank you
for coming.
Bye.
Bye.
Bye.